Hi folks, welcome to this video on discount bonds. This is just a sample quiz I'd given in the past and I thought I'd walk you through it just so that you could get an idea of what a quiz could look like and kinds of things you might be expected to do. It also serves as a really good review of discount bonds. So here we see that on January 1, 2011, the company issued face value bond 416,000, coupon is 5%. It's a 2-year bond paying semi-annually interest semi-annually every June 30th and December 31st. So we already know the number of interest payments are going to be 4, 2 a year for 2 years. Using your calculator, find the issue price of the bond. Market rate is 8%. Now we know that because the market is 8%, investments of similar risk are paying 8% in the marketplace in general. Your bond's only paying 5%. So that means two things to us. Number one, we shouldn't expect to get proceeds equal to or greater than the face value. The investor is only going to give us enough so that we can notionally recognize they can notionally recognize an 8% return. So by calculating the issue price, we would expect those proceeds to be less than $416,000. That's one thing. The next thing is that when you have a discount bond, because you cannot, as the issuer, pay interest equivalent to what they would get, they being the investors, if they bought 8% investments, your interest expense will exceed the amount of interest you're paying them. Why? Because the expense you're going to book on the income statement that exceeds the actual interest payment is viewed as a bit of a penalty to the issuer because they can't pay 8%. They're only paying 5%. So you would expect to get interest expense greater than the interest that you're paying. Another feature of a discount bond. So first thing we're going to do is see how much less than the face value the proceeds are. So we know that the amount of the future payment or future value we're going to make is $416,000. Your PMT is going to be $10,400. Now that would be equal to the face value of $416,000. I have a little calculation here. $416,000, which is your face. Notice it's times your coupon times 1/2 because each payment is made every 6 months, and that's going to give you $10,400. Notice you're using your market rate because don't forget when you're calculating the present value, you're calculating it using the market rate. Why? Because the investor is going to give you proceeds which equates to market value. So we use 8%. We have 4 interest payments, so if we did a compute PV, we'd have $393, $349. Now sometimes you'll notice in class what I've done is I put a plus minus to make the cash flow here negative because I'm looking at everything from the from the issuer's perspective. The issuer will have to pay out $416,000. They'll have to pay out $10,400 every 6 months. So I make it negative, right, when I use the calculator. If you didn't do that and you just left it ordinary like I did here, you would just do it at the end because you get a PV which is negative $393, $349, and all you could do is press your plus minus at the end to get a positive number because that's going to be an inflow, right? So in any case, you're going to get proceeds that are less than the face value. So now, to complete your amortization table, we do this table because we want to make sure that every period we can compare the cash interest we're paying out, which we calculated here for you, to the interest expense we're booking. And notice again, because it's a discount bond, the interest expense is bigger than the cash interest paid. The difference between the cash interest we're paying and interest expense is going to tell us how much discount we're amortizing. So this table is going to help us do two things. It's going to help us make our journal entries every 6 months to record interest expense, and it's also going to help us come up with the financial statement presentation on the balance sheet. So let's have a look at what the table looks like. You can see here I wanted you to identify if it's a discount or a premium bond, and again, because it's not premium, we know it's a discount bond. And our unamortized discount at the issue date would be what? It would be $22,651, the difference between the face value and the cash proceeds that the issuer got from the investor. So this is your unamortized discount. Notice that the amount of the unamortized discount plus the carrying value is always going to give you the face value of the bond. So the carrying value is going to be what? 416,000 less the unamortized discount, and that'll give you 393,349, which are the proceeds that you calculated, and it should be because we're at the issue date. So now notice that once we've got the carrying value in the table, you'll notice that the carrying value gets bigger at the end of every 6-month period. Why? Because at the end of the fourth interest payment, once that's made, the issuer has to pay back the face value, which is 416. So you'll notice the carrying value of the bond is going to get closer and closer to 416,000 because at December 31st, 2012, once the last interest payment is made, then the issuer is going to pay back to the investor the $416,000 face value on the bond. So we get this carrying value up to its face value. How do we do that? We have to keep amortizing some of this discount. So how much do we amortize? Well, remember what we said. Every time you book interest expense, you're going to amortize some discount. How much? The difference between the cash interest you pay and the interest expense you calculate. How much interest expense do we have? Well, using the effective interest method, we calculate that using the carrying value to open up the 6-month period. The 6-month period ends June 30th, so from January 1 to June 30th, that's your 6-month period. The carrying value times the market rate. So you can see here it's 8%, but because we've only got a 6-month period, we multiply it by a half, and we get 15,733. Notice again, discount bond, interest expenses greater than interest paid. That difference represents the amount of discount we're amortizing. So if we started off with unamortized discount of $22,651, and of that amount we amortized $53.34, the unamortized amount is going to be $17,317. So that would be the same as $22,651 minus what you've amortized of it, $5,334. And we do this all the way down, meaning that at December 31st, we'd pay out, based on our coupon rate of 5%, $10,400. We would recalculate the interest expense for the second 6-month period, which went from July the 1st, 2011 to December 31st, 2011. And that's going to be $15,947. How do I know that? Take the carrying value of the bond to open the 6-month period, which is $398,683. Multiply it by the market rate, because we're calculating interest expense, which is based on market, times a half because the bond is paying interest semi-annually, and we're going to get $15,947. Notice the interest expense here in the second 6-month period is greater than it was in the first 6-month period. Why? Because the carrying value of the bond that you're using to calculate the interest expense is getting bigger. And it should with a discount bond, because the discount bond, it's growing to its face value, which is bigger than the carrying value. So with each interest expense you book, you're going to find, because you're amortizing more discount, your carrying value is going to get bigger. So now we're left with the difference between interest expense and interest paid, which is discount amortized at $55.47. We only had to open the 6-month period that started July 1st, $17,317. So $17,317 minus what we amortized of it, which is $55.47, is going to give us $11,770. So now we're left with a carrying value of what? $416,000, which is the face value. So a couple of different ways you can do it. I prefer this way, but it's up to you. Less the unamortized discount. Some students like to think of it as the difference between, or the carrying value of $398,683 plus the amount of discount you amortized. It's the same thing. I like to use this method only because it's the same as the way it looks on the balance sheet. The carrying value of a discount bond in your balance sheet is face value less unamortized discount. So because I have an unamortized discount column, I like to use that presentation when I'm calculating carrying value. Again, it's up to you. Now we can go through to the next 6-month period that ends June the 30th. And again, we would make a payment on that date and calculate our interest expense as the carrying value of the bond, which is 404,230, times 8% market times a half because it's a semi-annual bond, and we would get 16,193. Again, a number bigger than the previous amount of interest expense booked because the carrying value upon which we're calculating the interest expense is increasing. So the difference between interest expensed and paid is your amortized discount, and the difference between 11,770, which was your unamortized discount to open January 1st, 2012, less what you're amortizing of it at June 30th, 2012 when you book interest expense is going to give you 6,001. So we're going to have a carrying value of 416,000 less 6,001, your unamortized discount, to give you 409,999. Now here all I did is round it because I wanted there to be no unamortized discount left so that I could bring the carrying value of the bond to 416,000, which is in fact its face value at the date we're going to discharge the bond or at the end of its term. Now you may wonder about rounding. Usually depending on the size of the bond, this is a smaller bond, 416,000, we're only at $1. If it was a $40 million bond, you might be out by maybe $3 or something like that. But I wouldn't worry about that. It's only rounding. In the world of multi-million dollars, $2 or $3 doesn't matter. Don't worry about it. Just a rounding issue here. Now, the next part of the question said to calculate how much interest expense would be incurred over the lifetime of the bond. And what I asked you to do is not to use your table. I wanted you to show me a calculation other than the table. Now, you'll remember we learned 2 ways to do this. We could calculate interest expense over the term of the bond by comparing what the issuer gave or investor gave the issuer at the date the bond was issued, which we calculated here in the present value, and compare what the issuer has to pay back to the investor. Well, the issuer has to pay back the face value plus $10,400 4 times. So they have to pay back, the issuer pays back to the investor $416,000 plus $10,400 times 4 because they pay that out 4 times to them. So the issuer AccuData over the 2 years of the bond would have paid back to the investor $457,600. But the issuer only gave, or the investor only gave you $393,349. So if the issuer AccuData has to pay back $457,600 and they only got $393,349 from the investor, the difference is the cost of borrowing to the issuer, and that's $64,251. You can verify that now by adding this up, but I wanted you to be able to calculate it without having to do the amortization table, because knowing what it's going to cost to finance the bond is important. So the other way you could do it is you could look at the interest that you pay out, which is your cash interest, plus your unamortized discount, because don't forget it's that discount plus the interest that you pay, that's goes into interest expense every period, right? So interest expense is the total of cash paid plus the discount you amortize every period. So it stands to reason that whatever you would pay out in cash over the term of the bond plus whatever you would amortize over the term of the bond, which you already know is $22,651 because you calculated it up front, is going to give you the amount it's going to cost you to borrow the money from your investors. So that would be $64,251, just as we had up here. Now, In Part D, we want you to make journal entries. The journal entries are being made to record the issue of the bond and interest expense every 6 months for 2011. So notice we're going to debit cash, which is what we calculated in the present value, and do a credit to the bond payable. Why? Because don't forget that $416,000 is what the issuer is going to have to pay back at the end of 2 years. The difference is your unamortized discount. Now the unamortized discount is a contra liability. Contra liability, normal debit balance, right? So when we are when we are booking interest expense, don't forget every time we book interest expense, we amortize discount. So amortizing means whittling away or dwindling it down. So we can tell that with our first interest payment at the date we made that payment, we booked interest expense of $15,734 and we whittled away at some of the unamortized discount, which was $53.34. So we're going to book that. We're saying we've amortized or reduced our discount by $53.34. We paid out $10,400 and we booked interest expense of $15,734. So you can get these numbers right from your table if you've done it correctly. And at December 31st, 2011, same thing. We're going to book interest expense of $15,947. We're going to credit cash for $10,400 and credit discount to record what we've amortized of the discount, $55.47. And you can see that's all here. So at the end of December 2011, in the non-current liability section of the balance sheet, we would describe the bond by giving it its account name, the coupon rate, and when it's due, meaning when it matures. And we know that's $416,000 because that's what we recorded at the issue date. We deduct the discount on the bonds payable, and don't forget that's the unamortized discount. Well, we can go to our table at December 31st, 2011 and find that at that date, unamortized discount is $11,770. And that's going to give us the carrying value of the bond, which should be the same as it is in the far right-hand side of the table, $404,230. And you see that right here, $404,230. Now, the last thing I've asked you to do here is what if AccuData, the issuer, decided to retire the bond a year earlier at December 31st, 2011, and in order to do that, they bought it back from investors at $405,000. Make the entry to record the early retirement of the bond on AccuData's books. And this entry would be made after the December 31st, 2011 entry. So what would we do? Well, first of all, because the bond's not going to be there at December 31st, 2012 to pay back the $416,000, we're going to remove the bond payable and remove any discount that we haven't yet amortized for the balance of the term of the bond. So that's why I say the first step would be to remove the bond, and that would be at its face value and any unamortized discount at that date. And the neat thing is you can get it right in your table, because at December 31st, after the interest is paid, you have unamortized discount of $11,770, and you already know your face value of your bond is $416. So this amount here is not going to be paid at December 31st, 2012 because you're retiring the bond. It's not going to be there. So the first thing I do is debit the bond and credit the discount. Well, I've already told you in the question how much you're going to pay the investors back to buy it back, which is $405. That's your second step. So your third step would be to plug for a gain or a loss. And you can see that when you add these two numbers, that's bigger than $416. So in order to plug it, you're going to have to debit a loss. So what does that mean? That means they paid $405,000, this is AccuData, to retire a bond that's on their books at only $404,230, right? So again, the idea is they're going to book some kind of a loss. And I just made a correction here because you'll notice that the loss to balance the entry should be $770, not $230. But the idea is still the same in that we still have to plug for any gain or loss. And as you see, the total of the debits was bigger than the total of the credit total was bigger than the debit total. So to plug it up, we needed to book the loss of 770. So this concludes our bond question on discount bonds. Next thing we're going to do is do a short video on bonds that are issued at a date that's different than the date they are available for purchase by the investor. So stay tuned.